Hi, welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me, Michael Becker.
Hey Paul, how's it going?
It's going great. And sitting over next to me over here is JC Castillo, JC with the Apartment Investor Network. JC, how are you?
Hey, I'm doing good, Paul. This is sort of a double up effort today. We've got the Old Capital Podcast and we've got the Apartment Investor Show that Paul and I host. And on top of that, we've got an amazing guest with us today. Why don't you introduce him?
We certainly do. We have Greg Willett from RealPage. And Greg, if you've known and read a lot of his articles, he is probably the number one quoted apartment economist in the nation. He's the guy that if you're building an apartment, if you own an apartment, he's the guy that kind of tells you what's going on. And so Greg is with RealPage, has been there for a long period of time. We've had him on the show numerous times. We're kind of going through some difficult times, I think, in the future. So we want to spend some time with Greg and kind of understand a little bit about what's going on today and what's going to go on in the future. So Greg, thanks for being on the podcast. We appreciate it.
Great to join you today. And you're right, I never run out of opinions, so I'll have plenty to talk about here.
So let's kind of talk, let's just jump right in, is we've had some choppy waters in the Treasury market recently. And what do you see overall in the big picture about what's going on today?
Yeah, the economy, lots of talk about inversion of the yield curve. I mean, that's meaningful, but I don't think it's necessarily beyond any sort of doubt that you're headed into recession. But I look at other things, like what happens in the monthly job numbers that come out, and those are slowing down from where we were before. There are monthly revisions to those, and the revisions now are always downward rather than upward. That's a little bit concerning. If you look at other factors like just what's happening in the global economy, concerns about Germany, concerns about China, those are really big economies that are going to have an impact on the U.S. And then maybe one that people don't pay attention to, but I think maybe they should, is what happens in the freight industry, in trucking. And as you're moving product from one place to another, that activity is down. That says that people are not building up their inventories, and so they're expecting slower sales ahead. So we've got some signs that we're headed toward some slowdown. I'm not necessarily going to call it recession, but I think we are headed toward a much slower growth environment than we've experienced for the last few years.
So we're at the end of August 2019, and we've just seen the entire year the 10-year Treasury is down, 100 basis points or more from the beginning of 19 to kind of 9 months or 8 months or so into the year. And then I read all these headlines about 17 trillion plus in negative yielding sovereign debt. Is there any way that we foresee or you foresee that the interest rates are going to rise in the near to medium term? Or is there so much downward pressure just due to the relative strength of our yields relative to the other sovereign debts that we're going to be in this low rate environment for the foreseeable future?
Yeah, I think we stay in low rates for a while. As you said, there is some downward pressure there to get at least a little bit of a cut as we move ahead. Frankly, I mean, they're so low now, there's not a lot of room to cut them. Yeah. But you might get a minor adjustment right away, and then I think you want to keep some dry powder. I mean, if we really do go into recession, have a little bit of room left that you could lower interest rates further.
And so what do you see kind of the U.S. economy as a whole? I know you're saying that we're seeing some indications, obviously slowing in the Eurozone. We have the transportation of the freight index that you just kind of referenced. What's kind of like your base case where we're kind of rounding out 2019? What do we see for the rest of this year, going into 2020, maybe even 2021? What's kind of your base case?
So we're starting from the rest of the year will actually be pretty solid. And even though we are seeing some slowing, I mean, the numbers are in good shape at this point. So we go on into 2020, some further slowdown. Job production, we're expecting at probably best case scenario, only half of what we're seeing this year, and it might be a little bit slower than that. And then we think the slowest growth period is early to mid 2021.
And then, so what are we seeing here lately, and then kind of what are you projecting for 2020, 2021 as far as job growth nationally?
Yeah, so we tend to think of the job numbers in terms of what's happening in the 150 largest metros. I mean, those are the ones where we do active forecasting. And so in those spots, you're at about 1.4 million jobs being generated on an annual basis. So we get on into 2020, by the end of the year, let's call it 500 to 700,000 jobs, and then slowing down a little bit more than that as we get into early 2021. So, I mean, that is a meaningful slowdown, but you're really at kind of the cut point of would you define that as a recession or not?
Do you see any certain sectors or regions that are going to be more susceptible or should be more resilient as we project a little bit more of a slower growth in the job growth, basically?
Certainly, we think that the Texas markets will be at the top of the list of performers. And then I think we've talked a couple of times, we're really big fans of the Carolinas and Tennessee, and we sort of think of it as a junior version of Texas. So still some good numbers as we're getting over into the Southeast. What I would caution is watch those tourism-based economies. Those areas tend to stumble a little bit more than others whenever you go into a slower growth period.
Orlando, your Vegas.
So, and Orlando is a good example of one where we think that we might see some slowdown. And then we are concerned about what's happening with trade at this point. And so areas that are dependent on international trade, and the one that really jumps out at you is Southern California in that situation. So those would be toward the bottom of the list, and in those areas it wouldn't be surprising to see basically flat job numbers or even some job cuts. But other places still doing reasonably well.
Last 8 or 9 years, we have had unbelievable capital flow, whether it's the debt side or it's been just equity that's been flowing into the markets. What are your crystal ball saying about what's going to happen with Fannie Mae and Freddie Mac coming up here?
That capital's still going to be there, still chasing deals, trying to get it deployed. So we don't really see much change there. I was on a panel at an industry event recently where it was referred to as the wall of capital. The wall of capital is still going to be in place, and in some ways maybe even could grow as you make international destinations less attractive for investments. Even if you've got some slowing here, it's where the money is going to be headed.
Everyone's looking for yield. So they're
looking for yield, and the apartment markets especially, and here's a wild card. I don't really know how this is going to play out as we're starting to hear conversations about rent control in some places. JC, you're in California, and it's a big deal there. And so does that push the capital into other locations and then drive up the pricing in those other markets?
That's been one thing. We were last year in March, it was, and Oregon had just passed their statewide rent control, and then here maybe 2 months ago or so, New York has completely increased the level of draconian restrictions on the rent control law, where now on vacancy you can't improve your unit and then raise it to market rent, so you're stuck with like a cap of 2 or 3% or whatever it is. And just kind of anecdotally, we've been seeing more 212 phone calls coming in from guys from New York and the Northeast trying to seek for properties in Texas, where historically more guys from like JC's backyard comes to Texas and the New York money goes to Florida. So it seems like, just anecdotally, it's pretty early, but it seems like the capital is starting to flee. Do you have any sort of additional thoughts on kind of the New York market now that the rent control laws have come in, and been a little bit more draconian than they were?
Well, you referenced Oregon and New York. I mean, what Oregon didn't really change the world in a big way. I mean, the limits they put on how you can push rents were so that you were not really restricting much of anything relative to what's happened in those markets in the past. New York was a big deal, and you've immediately had major owners and operators there saying, we're going to stop any product upgrades. I mean, you'll do routine maintenance, but we're not investing further in these properties. I mean, that's a scary thing to emerge in a market of that size. So I don't think other places are going to go that extreme, but you're going to have some of these. You're going to have more local rent control restrictions popping up.
There's something between 1 million and 1.5 million rent restricted units in New York,
Right,
right? I mean,
right.
so
Yeah,
like
yeah. I think you're right at 1 million.
yeah, so this is a material number of
That's
units.
right.
Have you guys changed your forecast since the last change in the law here for the New York metropolitan area?
We haven't really made adjustments solely based on that. Something to pay attention to in New York has been, it's a market that's gotten a lot of new supply in the past few years. That's winding down. So in terms of what happens in the next 2 or 3 years, that's probably a more significant storyline than what happens with rent control, but it does change your long-term view of New York.
Yeah.
You know, Greg, we've all been at this for a little while, and we're obviously all aware of the fact that we're a little bit long in the tooth in this market cycle. And that's not necessarily to say that we've reached a peak or haven't, but you're out there talking with a lot of operators every day across the nation. What are these operators doing at this point in the cycle to prepare themselves for a potential shock, or just to prepare themselves in general? Are they making any transitions in terms of what they're doing today versus what they were doing 2 years ago?
Yeah, I love that question. And keep in mind that we're coming from a place where the market is in fantastic shape right now. Demand in this prime leasing season has been pretty phenomenal. The only stronger period in this course of this economic cycle was right when we were coming out of recession in 2010 or so. So we've had great demand, and even though we're delivering a lot of product, occupancy has trended up. We are now at the highest occupancy rate for the U.S. as a whole that we've seen since, I think, go all the way back to 2000. So the strongest occupancy in 19 years. And solid rent growth. I mean, nationally, a little bit north of 3%. So those numbers are all good. But to your point, people are concerned about what happens ahead. So one of the reasons occupancy is so strong is because operators have raised their target occupancy. And if that means give up a little bit on rent growth to get to that higher occupancy so that you're as full as you can be if there's an economic downturn, that's what they're doing. So that's step one. I think step two is pay attention to what you're doing on the expense side of the equation. Is there any fat there that you just haven't been paying attention to because operations have been going so well? So you're starting to think about that. And then kind of bread and butter stuff. I mean, think about maintenance and resident relationships and just what does the property look like, the curb appeal. You pay attention to that really basic operational activities whenever you're concerned about the market overall.
Yeah. The other question I have is, we hear a lot of people talking about making the move to tertiary and secondary markets and sort of going away from sort of these tier one markets because the yields are better, the cap rates are better. Where do you see these operators making their moves now, given the fact that we are heading into maybe somewhat of a little bit of a turn in terms of maybe protecting their downside? And are they still willing to go to these secondary, tertiary markets, or are they sort of rethinking that strategy?
At this point, and really over the last couple of years, the smaller markets have actually done a little bit better than the big markets have, partly because they haven't had the level of construction. So I think for a lot of folks, it's still an attractive play. You have to think about a couple of cautions that I would throw out there. You have to think about the economies in these smaller markets and how dependent are they on one industry or on one specific employer, because that can turn very quickly. You have to look at what the other housing options are. Usually for sale product is more affordable in these small markets relative to what you see in the big markets. So is something going to happen that is going to spur more purchase in those markets? So a couple of things to be cautious about, but there are still certain secondary markets that we're pretty hyped about. And we, in fact, during the course of the year, we periodically will stop talking about the big markets and say, hey, let's look at where some of these opportunities in the smaller markets.
So where would that be right now? You recently, like, what are the markets right now? We're two-thirds of the way through the third quarter, like the secondary markets. What are your most favorite ones?
We like some of the small markets in the west region of the country. California, you got to be careful with California all the time, but places like Reno and Boise are attractive. We've done a recent webcast that focused on the south region of the country. We, for example, like Huntsville, Alabama was one that we featured recently. And then my personal favorite take on this small market play, college towns.
Yeah.
I mean, it provides a really solid base to work from with if there's a major university there. And then a lot of times it's also, if the university is there, it's a major healthcare center too. So again, providing some stability that you don't see in some other markets.
Moving kind of more the major markets, anything that's either overperformed or you project to still do well going forward, and anything that you're a little bit more concerned about due to either economic reasons or supply reasons?
Again, we still like the Texas markets for the most part, although Houston is certainly underperforming in a significant way right now. And again, we like Carolinas, we like Tennessee, we like that southeast area of the country. If we go to major gateway cities, we still like Boston, we still like Seattle, but again, Southern California losing steam in a significant way.
Losing steam which way?
It's chronically undersupplied, so it's always going to be full, but in most Southern California markets, rent growth right now is only half what it was a year ago. So some real slowdown there, and you are starting to see the job numbers deteriorate more quickly in that area than you are in some other places across the country. So a little bit of caution there. And then, as I've said, these places that have the big hospitality industry, be cautious.
So we were here, like I said, last in March, and I asked you about the SALT, and you said if it's anything is affecting kind of the third digit, right? It's not really it had too much of an impact. Have you seen that change in the last 6 months at all, or you don't think there's been too much of that slowdown? Because obviously California would be more impacted, New York, Connecticut, Chicago, Jersey.
and just in terms of to me, to the degree that there's any ability to see that doing anything, it's in the Northeast, it's New York, it's New Jersey, more so than it is anywhere else, and then partly reflecting that, but then for other reasons too. Those are not great looking markets at this point.
Oh, good. So we JC and I own a bunch of properties in Dallas, and I own some stuff in a couple other markets, and Paul loans a lot of money in Texas. So maybe we can talk a little bit more about the four major metros. Maybe starting with your least favorite, Houston. Seemingly, last time we were here, they had a big recovery, seemingly overnight after the hurricane, and then that started to tail off back in the first quarter of 2019. Has that continued, obviously, for the rest of the year?
So the good news on Houston is in prime leasing season this year, you did have demand come back. I mean, that was step one you needed to see in that market. So good demand, occupancy has moved up a little bit, but it's still really low compared to other places across the country. And you're still not getting any real rent growth in this one. So it's a laggard relative to other places. And then, to add further concern here, we had this period where we were not delivering product because you didn't have starts whenever the energy sector was struggling. The amount of product that is about to come out of the ground in Houston is really big. Units under construction, that's doubled in the past year. So we're going to have some. Dallas is still going to be construction central for the near term. Houston is moving up alongside Washington, D.C. to challenge for that second spot.
So you don't see anything in the near to medium term that's going to change the performance within the Houston metro as a whole? Everything's still going to be lagging other places in the country in your estimation?
As we look forward over the next, let's really take it longer term, 3 to 5 years, we have Houston as a middle of the pack performer nationally, which is an upgrade from being at the bottom, which is where they are right now.
Got it. Okay. Moving to the slow and steady market, the boring market, San Antonio. It seemed like that last time we were here that the Class A was actually performing a little bit better than the workforce, which is a little different than most metros across the country, but still kind of slow and steady and nothing super exciting. Still pretty much status quo.
Yeah, I mean, if you talk to me about San Antonio 6 months ago, I probably would have said the same thing. If you talk to me 6 months from now, I'm probably going to be saying the same thing. I mean, it just doesn't move much, and so if you like stability, you like San Antonio. I don't think it's ever going to be a home run, but it's not a problem child either.
And then moving to the high-flying market is Austin, or at least that's been here recently. We've been seeing, I think, upwards of 5% rental rate growth kind of year over year. Is that still what we're seeing? I know more supply is starting to deliver, so is that muting the rental rate growth? Or I know the occupancy had ticked up after a slowdown in 2015, 2016 with the glut of supply. Seemingly that the occupancies are up 50 bips, 100 bips kind of as a whole in the market. What's kind of your take on Austin right now?
Yeah, Austin has pulled away from the pack. I mean, it's certainly the best performer on rent growth right now. A lot of construction, as you mentioned, but something we like about Austin is they don't put everything in just a couple of neighborhoods.
Right.
You have a lot of construction, but it's all across the metro, and so if you spread it out, that makes it easier to digest it.
Yeah.
So we do think that Austin will be a premium performer nationally throughout our 5-year forecast period. We have it staying in that top tier across the country.
And then, of course, the biggest markets where your home base is, our home base is Dallas-Fort Worth. Any thoughts about Dallas-Fort Worth? It seems like we're delivering 30,000 units every year, and it seems like the developers keep building more and more and more units. What are your thoughts kind of as the metro as a whole, and then maybe kind of divide the two sides, Dallas and Fort Worth?
Right. So Dallas-Fort Worth, king of construction. We've got about 45,000 units under construction at this point. It's been holding at that level throughout recent years. For every unit we finish, we seem to start another one. So to some degree, if the economy slows down, that's some vulnerability because you're going to struggle to get those new deliveries through initial lease up. But at the same time, we think there's less of an economic slowdown here. And then coming out of any sort of slowdown, Dallas-Fort Worth probably will lead the charge back. So you can get a little bit of a blip there, but we don't think it goes off the rails. And that would certainly impact the A product much more than it would B and C. And to your point, there is a little bit of a difference between Dallas and Fort Worth. Most of that construction is in Dallas. Fort Worth looks pretty strong moving ahead. And we would have it not quite at the level of Austin, but pretty close.
Got it. And then the supply that is in Fort Worth tends to be in the in-town market, and the suburb maybe a little bit up towards Alliance, but the rest of it's pretty.
Just not a lot of building activity.
Good.
Greg, we talk a lot about a lot of supply coming to various markets. I'd be interested to get your take on. I always talk about the idea of also look at the net absorption of that product coming online. So maybe give a little bit of your take on these markets where we've got some significant supply coming and what you're seeing in terms of the absorption rates that are happening in these cities.
Are you doing a plug for me here? Because we have a webcast coming up in a couple of weeks that really focuses on demand. It's like
Hey, we're operators, and so we just talk about what's important to us, and I figure it's going to be important to you too.
So you have a ton of attention that's always focused on supply. Are we overbuilding? We're building a lot, but that's fine if demand is a lot too. So we're going to look at demand over the course of this economic cycle, how huge it's been, what has supported that demand, which is partly the economy, but it's also a story of demographics and evolving lifestyle preferences. There's not you don't feel like you need to go buy a home if you're a young adult, which is very different than when I was a young adult. So we'll talk about that and where have been the demand leaders in small markets and big markets. And so, yeah, I think a underappreciated story is that demand story. And from our perspective, particularly if you look at demographics, there's still another decade ahead of us when the demographics are going to look great. So yes, you might have an economic stumble in there, but big picture, these people are coming and they're going to have to live somewhere.
Mm-hmm.
A lot of people have not gone through cycles, and I've gone through a number of cycles. You guys have gone through a cycle or two. So, I'm always concerned that a lot of people who've gotten into the multifamily business and buying the B and C properties, who flipped houses 2 years ago, had some cash and put it into multifamily, they've done very well, but they've never gone through a cycle. What's your advice, or what do you see for signals of a slowdown? I know jobs, we talked a little bit about that, but really what happens with the operations of a property? How do people be proactive to try to help themselves, not be the last one holding the flag?
Yeah, and as I talked about a little bit, play some defense and keep the property looking good in a downturn. That's really maybe my number one takeaway is when people drive by, you still want that property to look like an attractive place to live. And also, as you're thinking about, think about your residents and trying to establish relationships with the residents. People are actually staying in place longer now than they ever have in history. So they're not necessarily looking to move from spot to spot. And then be careful as you're doing new leases right now on who's coming in. Maybe leave a little bit more on that rent to income ratio than you would have a couple years ago.
So if you go back to, say, 2010, 11 or so, and we had the last big down pull of the market itself, what happened to folks that own multifamily properties, and how long did that downturn last before it started to go back up again?
And also, let's keep in mind that going back to that last downturn, that was called the Great Recession.
We got it.
For a reason. That was not a normal downturn. And so I think there was more pain there than you would typically see. And so you had a significant loss in occupancy. You had rents come down in a big way, and not so much in Texas markets where you guys operate to some degree, but there were some other places that you had some really big rent cuts, and so you have to be concentrating on just day-to-day cash flow in that sort of environment, and hopefully you've planned for again. It's a cycle. At some point, there's going to be a downturn. Are we exactly right? And when we're saying it's going to be, probably not. But at some point over the course of the next 5 years, there's probably a year to a year and a half where you're just going to be struggling. and you're going to have people on your properties who are losing their jobs and turning in the keys. So you got to be prepared for that and ready to go and get those units turned and get them out there in the marketplace. And
Mike is a former banker and is an operator right now. What are you trying to be proactive on in these markets?
I mean, we use Greg's to plug one of RealPage's products. We use LRO for the lease rent optimizer for our revenue management software, and we're trying to like Greg was kind of alluding to, maybe ticking up a percentage for our target occupancy, maybe trying to get a few more 15-month leases in there, and depending on the property and the location of it, if it's near supply and it's an A- product, maybe we want to get a few extra 15-month leases and maybe take the average expiration from 8% a month to 6.5 or 7 on that property, so we don't have quite as many vacancies and extend and play a little bit more defense and, like you said, focus on cash flow a little bit as well.
And I was also, I'm sure that you're watching those lease expiration times too. You want those leases to expire primarily in prime leasing season where you can get somebody else in there versus don't have them expiring in January and February when there's no traffic coming through your front door.
That's right. So.
Anything more that do you think is on the top of your head that we should be talking about?
I can always talk about technology here at RealPage.
Yeah, is there any tools that you think would be useful, just in general or in particular useful if we hit a little slower economic environment than maybe not?
Yeah, the one thing I would really plug is pay attention to your marketing spend, and are those dollars being spent effectively, and are you checking on whether you're hitting the right people and those are really turning into leases versus are you just putting that out there and then maybe you're even generating leads, but are those lead closable leads?
Right. Yeah.
So pay attention to the marketing efforts and the messaging that you're putting out there.
Any wild amenities that you're finding on some of these Class A properties that are just unbelievable?
Hey, we usually call it the amenity war, and it's not going away, but I just kind of feel like we've run out of stuff to do in terms of the physical features. And so what we're seeing now, it's much more focused on services and concierge and taking care of the residents and everything you can do to make their lives easier and save them time. And then any awesome thing you can do for the pets. The pets are always, it's not.
I just joke, but it's true. Like everyone that leases a unit from us has a dog and a tattoo, and that's just kind of how it is nowadays. And it wasn't that way 10 years ago, but just how it is.
Have you considered a tattoo removal area as an amenity for your property?
That'll probably be 8 or 10 years down the road, right?
That's why we get you on the show, Greg, because you've got all the ideas.
There's the great idea.
Exactly.
So I think we'll probably end it there. So let's go around the table. Anything more, JC, to ask or add?
I would just say that when this video goes out live, I think that it's folks like Greg Willett. You don't get the chance to sit down with guys like that very often. And for all you folks out there that are watching this Apartment Investor Show episode or listening to the Old Capital podcast, you should probably replay this maybe 2 or 3 times. Because seriously, he is the chief economist at RealPage for a reason. So pay attention to what he says. Even though we do know people that say, what do they say? 50% of the time they could be right, they could be wrong. But Greg is certainly a person that you absolutely want to pay attention to when it comes to this type of stuff.
And you want to know more information about RealPage, go to realpage.com. And there are a wealth of information. Yeah. Greg puts out a lot of data about what's going on with the economy itself and what's going on with the history and the data and the statistics of different areas. So he does a great job. So make sure that you sign and get on to realpage.com.
Yeah, just take away, be a little more defensive. But from what Greg is saying, the sky's not going to likely fall, at least on us in Texas. Maybe it'll be
a little lower a little bit.
But trees don't grow to the sky, and we've been in an unbelievable environment. And maybe we have a few, a year to 2 of a little slower growth, but hopefully we'll come out the back end. And in the meantime, these rates get going lower and lower and lower. So that should, if you're on an adjustable rate mortgage, you'll certainly be the beneficiary of lower debt service because I don't see what in the world is going to make our rates go up at this point, because you have 17 trillion and growing of negative yielding sovereign bonds. So it's just going to put a cap and just, put downward pressure on the U.S. Treasury rate. So seems like we should have reasonably clear skies ahead, and just kind of try to be a little more defensive, and just kind of make sure, like he says, take care of your asset, and your asset should take care of you.
That's great. So don't forget, October 24th, 25th, the Old Capitol Multifamily Conference at the Dallas House of Blues. Dallas House of Blues, 24th, 25th. Our keynote speaker this year is Lou Holtz. So we're looking forward to hearing Lou Holtz again talk a little bit about do the right thing, not only for your property, but your limited partners and for your bank too. Making sure that we're all playing by a good set of rules. And if we do have a slowing of the economy, I think we're going to have a rocking chair panel, and the rocking chair panel will be 5 people that have been multifamily as principals, as owners of properties, management companies for 25 to 30 years. Listen to some of their stories and what they're talking about, how to get through maybe a recession, maybe a light recession that's coming up our way, how not to get sued, how to make sure your balance sheet stays intact, how to make sure that you handle capital calls if your partnership needs more money. Listen to some of the ways that these guys talk a little bit about what their experience level is. So we'd love to see you at the Old Capitol Conference. Go to oldcapitalpodcast.com, Old Capitol Podcast, to join us on October 24th and 25th. JC, a pleasure. Thanks for jumping in the podcast with us. We appreciate it. We appreciate it. We're looking forward to the next podcast with you. Greg Willett, thank you very much. We appreciate it. Thanks for your time. If we do have a slowing up of the economy, your data is going to be much more important in the future than it has in the past. So we look forward to listening to you about a lot of information going on. Michael Becker, always a pleasure. We appreciate it. I'm Paul Peebles. Have a great day.